As told by Fortune, if you read just one book on investing during your lifetime, make it this one. And praised by Warren Buffett as the best book on investing ever written, The Intelligent Investor by Benjamin Graham is the investor's classic where its principles have stood the test of time. Graham is the father of value investing and was Warren Buffett's mentor. In his book, rather than giving many formulas for analyzing stock, he focuses on investment principles and investor attitudes, which many consider even more important. Graham defines an investment as something that you've analyzed carefully. You know exactly what you're buying, you've minimized risk, and you know it's stable for the long haul. You also know that it will give you an adequate return, either through an increase in share value or through healthy dividends for the price you pay. Everything else is just speculating. If you are watching the market, following stock prices and then placing value on its movement, you are speculating. As Graham says, in our own stock market experience and observation extending over 50 years, we have not known a single person who has consistently or lastingly made money by thus following the market. We do not hesitate to declare that this approach is as fallacious as it is popular. Although some speculation is necessary and unavoidable, because there are great possibilities of both profit and loss, the task is to keep risk within minor limits. It's like a unique kind of casino. You will not lose in the end as long as you stick by the rules that put the odds in your favor. Not that Graham was entirely against speculating. He says that while it can be fascinating and fun, you should never mingle your speculative account with your investor account, and you should never put more than 10% of your money into this mad money account. Looking over the stock history, Graham comments on what he observes as random economic boulevards. He takes note of an annual advance of 3% here until 1924, where we saw the roaring 20s, followed by the greatest crash, and then after a 25-year recovery, we saw a great bull market with an annual increase of 9% until 1970. Earlier in our century, we saw the crash of the tech boom and then another collapse in 2008. We are a decade into another advance, and perhaps that helps explain why some of us walk on tiptoes, awaiting an end. There seems to be no pattern to the highs and the lows, so we cannot rely on historical data to accurately predict the future. The lesson here is that we should keep our eyes on the long-term outcome. There is no way of knowing what the markets will do. The term long-term investor is redundant. There is only one investor, and it is the only kind of investor there is. When investing in stock, Graham says the last thing you should be looking at is actually the market price, because the company's underlying value doesn't vary dramatically day to day. Don't get caught up in market sentiment driven by investor emotions of panic, euphoria, and apathy. Graham invented Mr. Market, a now famous parable to illustrate this. He asks you to imagine that Mr. Market is your business partner and you own a company together. Now Mr. Market wants to buy his share in the business, and every day he offers you a price. As he is a sentimental guy, his price may well be above or far below the intrinsic value of the company's stock. Over the 10, 20, 30-year investment horizon, if the intrinsic value of the stock is sound, Mr. Market's daily dipsy-doodles simply do not matter, because good profits and sound business will eventually be recognized. In any case, for anyone who will be investing for years to come, falling stock prices are good news, not bad, as they enable us to buy more for less money. The further and longer stocks fall, the more steadily we keep buying as they drop, the more money we'll make in the end. Remember, market quotations are there for convenience, either to be taken advantage of or to be ignored. Then why even bother? Because of inflation. As the years go by, inflation will eat at your money and it will buy less and less. For planning purposes, we should be factoring in -3% per year. Ensuring that its impact is minimized is the first critical step in investing. Despite regular ups and downs in the market, stocks have consistently earned more than investment-grade bonds over the long term, and that is reason enough for most investors to hang on to stocks as part of a diversified portfolio. Although not Graham's preference, other assets that keep or outpace with rising inflation is real estate, REITs, and tips. Because of the volatility risk, you shouldn't put all your money into stocks, nor should you put everything into bonds or cash, because they usually don't earn enough to beat inflation. So diversification is key, and balancing these two is the right way to go. Graham recommends a balance of 50% bonds and 50% stocks, and he's very strict on a minimum of 25% bonds and never more than 75% in stocks. Buy a representative mix of value stocks and choose them for their value rather than their popularity. Graham suggests putting a third of your money in mutual funds that hold foreign stocks, including those in emerging markets, for greater diversification, then periodically rebalance stocks and bonds every 6 months. When buying bonds, aim for high-grade bonds and use bond funds from major firms like Vanguard, which offer a broad menu at low costs to spread risk. Bonds are usually sold in $10,000 lots, and you need a bare minimum of 10 to diversify. So unless you have $100,000, use bond funds, but avoid bonds from emerging markets in foreign countries unless you're confident. To invest in stocks, you can choose one of two approaches: passive or active. Graham recommends the majority take the passive route, as most don't have the time or the determination to be an active investor that requires constant reading and watching and understanding when opportunities arise. Stock selection for passive investors is more strict to protect against serious mistakes or losses. The appeal is freedom from effort, annoyance, and the need for making frequent decisions. The goal is to purchase a diversified list of 10 to 30 leading common stocks and to make sure that the price isn't too high. You can do this through the Dow approach, where you buy the same amount of all stocks in the Dow, acquiring a true cross-section of leading issues. These days, you can purchase low-cost ETFs which track the market, like the S&P 500. Or you can self-pick and apply a set standard to each. You want to read through a company's income statement, balance sheet, and cash flow statement, which can be found on their company website or many online databases such as Yahoo Finance. Then make sure they meet the following. The company needs to have a total market value of not less than $2 billion and more than $500 million of annual sales. There should be twice the current assets of current debt. The long-term debt should be less than net assets. There should be 20 years of continued dividends and 10 years of positive earnings. There should be a 10-year growth of at least 1/3 in earnings per share. The total market price should be no more than 1.5 times net asset value. This is also called book value per share. The price is no more than 15 times average earnings of the past 3 years. This is also known as price to earnings ratio. Then finally, you need to make sure that the market share price is less than the root of 22.5 times earnings per share times book value per share. Nowadays, the best choice is a total stock index fund and only sell when you need the funds. If the investment approach is long, at least 25 to 30 years, there is only one sensible approach. Buy every month, automatically, and whenever you can spare some money. This is known as dollar cost averaging. By putting much of the portfolio on permanent autopilot, you can fight the prediction addiction, focus on your long-term financial goals, and tune out Mr. Market's mood swings. And if you find yourself trading more than twice a year, or spending more than an hour or two a month, then something has gone wrong. The determining trait of the active investor is his willingness to devote time and care to the selection of stocks that are both sound and more attractive than the average. The aim is to look for companies that have a good showing, have a satisfactory past record, but appear to hold no charm to the public. Then when we buy with a safety of margin, so at a bargain, which can be like finding a needle in a haystack by flipping the most rocks, which can be very time-consuming. Over many decades, we can expect a worthwhile reward for the extra skill and effort in the form of a better average return. Returns can be seen by even up to 20%. The allure is that even a 2% increase in returns can more than double your money in 50 years. The following are clues that a stock is a bargain. Here it is more an art than a science, as investors like to chop and change their criteria to suit their needs and risk tolerance. But you want to largely look out for a PE ratio of 9 or less at the end of the year. Current assets should be at least 1.5 times current liabilities. The debt should be not more than 110% of net current assets. There should be no earnings deficit in the last 5 years, some current dividend, and some signs of earnings growth, as in last year's earnings should be more than those of the year before. The price should be less than 120% of net tangible assets. And then we want to make sure that the share market price is less than the root of 12 times earnings per share times book value per share. Then apply a margin of safety. So there are many different ways of factoring this in, but Graham suggests to find earnings yield and make sure that it twice covers the bond interest rate, which can be flexed according to risk tolerance. The earnings yield is found by dividing market price from earnings per share. This is the most important step as it allows for us to absorb the impact of market fluctuations, miscalculations, or any future shortfalls of the business. You also need to ensure good management. Here comes the qualitative part of analyzing stock. Ask questions like, are they looking out for number 1? So look out for large CEO salaries, company reprices, reissues, and look out for insiders consistently selling shares. What does the company executive say, and do they do what they say? Read annual reports to see forecasts and if they fulfilled them or fell short. Are they competitive? What is their moat like? Do they have protection against competition? Are their financial results transparent or opaque? Look out for non-recurring charges that keep recurring, or extraordinary charges that keep popping up, that they are becoming ordinary, or pro forma earnings that are used to cloak actual losses. Remember to hold stock for at least 1 year and whenever possible, for at least 5 years to lower your capital gains liability. And you can make a profit when they return to the intrinsic value or above. Remember to trade infrequently. Research has shown that those who trade frequently after trading costs actually lose money. They found that those who trade more than 20% of their stock holdings per month lose 6.4% per year. If you want to learn more about the technicalities of analyzing stock, then Graham recommends you read his earlier book, Security Analysis.